doing?
Good to see you again.
Likewise.
I have a very interesting story to tell you because I'd like your advice. So I have a friend who has a wonderful business. He's a distributor for a wonderful European product in the US, and his supplier wants to retire. They've been in business for a while. They've made a wonderful business, but they're too old now and they want to sell the business to him. He doesn't have enough money to buy it himself.
Okay.
He would need to find money somewhere.
Okay.
Who could fund this transaction?
I would say if your friend is distributing a physical product, it's unlikely that that company is going to be a style of business that a VC would like to back. There are a couple of ideas though I have. All is not lost. So let's, working assumption, 20 million business, 10 million in the US. Let's assume that. One way of doing it is that you do what is called a vendor loan note. In other words, the company that's selling their business to you also provides you with the finance. So let's suppose that the agreement is to buy it for 1 times revenue for 20 million. Mm-hmm. A European company, agree to sell you my business for 20 million to the American distributor. So you sign a contract and therefore the American business owes the European business 20 million. But the funding for that has come from a loan from the seller.
The vendor. Yeah.
This is a retirement project, so it may well be they just need an income. They don't need a big lump of capital, mm-hmm. and they'd be quite happy. You can set an interest rate. It would be common to have an interest rate on it. I don't know, 6% or 8% or something like that on the loan. It would be a better return than they could get by leaving the money in the bank, at current interest rates. If the buyer is unable to pay, is not generating enough profits to pay for the capital, then you can have a situation where the seller gets the company back. In other words, it's guaranteed by the shares. So there are lots of advantages of it. That is a possibility. And the second one would be a search fund. So
what is a search fund?
A search fund is where an entrepreneur doesn't have a business but would like to run a business.
Is that an entrepreneur actually?
Well, that's a great question. I think so. Yes, I think they could still be someone who wants to be independent, wants to run their own business, and so on, even if they don't come up with the idea. Mm. So search funds are very common, again, when there's a change of ownership from one generation to another. So the idea is that like with venture capital, you have investors in the fund,
LPs,
in the search fund, LPs, exactly the same way. But one individual entrepreneur is essentially the GP, and they're looking around for an investment opportunity, and they'll be pulling down a small amount of money from the investors to pay their expenses. They will be expected to find something within, let's say, 2-3 years.
So are they paying the entrepreneur to look for a business?
Yes.
To buy?
Yeah. And then when they find a business, then the fund pays for the acquisition of the business, and the ownership of the company is shared then between the entrepreneur and the fund. So that's in that way quite similar, mm-hmm. to a venture business. The advantage for an LP is that these are established businesses with customers with probably profits, and therefore the failure rate is much lower.
So in that sense, it's similar to PE, we could say.
It is actually, in a way, a search fund is a mini PE structure, except you've got this entrepreneur. It's like a management buy-in. You're coming into a firm to run it. So there is some commitment from the LPs into this. They have to choose the entrepreneur carefully. That they are, and of course the challenge for the entrepreneur is they've got to find a good business. They can't take the first thing that comes.
What sort of thing are they looking for? I mean, you said most likely has profits, it's predictable, it's an established business.
Yeah.
But how do I distinguish one from the other? I mean, a venture capital firm can build a portfolio, right, of a number of businesses.
That's very true. Here you can't.
You have one shot.
Yeah. So well, as an entrepreneur's perspective, you have one shot. Whereas an investor, you go into multiple opportunities.
Multiple funds.
Yeah.
Search funds.
But as I say, I think the failure rate is not so much the problem, because they're investing in companies that are generally established.
Mhm.
So let's look at the other end. Are they going to take one invested euro and make it into 100? Probably not.
What sort of return rate are they looking for?
Well, actually, statistically, the returns from search funds have been very good so far.
Around how much? Do you have a number?
I think the last survey I saw that they were getting IRRs close to 30%, which is
Wow.
better than PE. And of course, you're up there with the top VC firms.
How's that possible?
Well, it's because this unique thing of the problem with VC is you can get these great returns, but a large number of the companies just don't make it.
Yeah.
Whereas here, I think your chances of success are high if you've got the right entrepreneur who's just come out of business school, probably in their early 30s, got a tremendous amount of drive and some experience. They can probably take over from someone who's retiring and has run it for a while and not being very growth oriented and really turn it around. Also, the valuations going in are not particularly high for a company like that.
Yeah. Do they leverage the business once they buy it?
They may well do. They may well do. Yeah, I have some concerns about. They've essentially got a big burden of debt that they have to give their investors a return, so they have to be able to change the growth rate really
increase it.
Really increase it for them, because you know how these investments are structured. It's going to favour the investor the returns are going to favour the investor unless you can really get the growth rates going, until you can grow the value of the business. So that, I think that's one. And then the other one is, how do you exit? Because a lot of these family businesses that you're taking over were probably never built with the idea of exiting. And although you may well remain involved with the business much longer than you would for a venture, venture is kind of 3, 5, 7 years is kind of the time frame that's one's looking at. For a search fund, it may take longer. It'll be likely more closer to the 10 years, because you've got to be able to turn it around and grow it, generate enough value in order to be able to get a decent exit.
What sort of exit opportunities do these companies normally have?
Well, I think mostly a strategic buyer. In other words, you'd be selling probably to private equity or some other owner of a competitive business, or
So that example you said at the beginning of a company who's in the same industry, looking to grow, looking to diversify.
Exactly, or you're present in one country and it's a company that's trying to expand into the country, or they're adding a product range or whatever. There are examples of being able to IPO but you really have to get the business going and get the profile. The logic for private equity is that you can lower the cost of capital through the use of leverage. And the logic of venture capital is you can come in early enough so that you ride the wave and then you can exit a very high valuation. The logic for a search fund is that you are changing the shape of the growth curve so that you're increasing the multiples, the valuation multiples. So if it's 5 times EBITDA when you buy it, you're going to get it at 10 times EBITDA when you sell it.
Sort of like multiple arbitrage.
It is a little bit multiple arbitrage, but also you want to drive the EBITDA up. Mm-hmm. So let's suppose you double the EBITDA and you double the multiple, then you've got a 4x.
And how do you manage to do that? Is that selling more, investing into marketing?
Well, I do think it's a lot of it, in this sense, similar to private equity, is that a fresh set of eyes, you come in, you streamline, you're more aggressive on the sales side, you push harder,
Increase the efficiency.
Increase the efficiency, yeah.
Okay.
So I think P is probably more focused on increasing profits, whereas I think if you're an entrepreneur coming in, buying a relatively small business, your focus is probably on growth.
That sounds more entrepreneur-like mindset.
Yes, probably is. So how does that match your friend?
Yeah, I think it's great. I think he will raise a search fund with no search because he has found the business already.
Yes, correct. That's absolutely right. He should explore also this idea of a vendor loan note, because it may well be that he can buy the business.
getting money from those.
without having external investors.
He will be very interested in
Okay.
hearing about this. Thank you
All
very
right.
much, David.
Pleasure.